Hi, everyone. Thank you for taking the time to join this webinar, Emerging Markets Equities, a Turnaround in Sight. My name is Kate Keenan, and I am the Director of Client Services at Sunbridge Capital Partners. For those not familiar with Sunbridge, we are a boutique asset manager focused on investing in emerging markets equities. We manage one strategy, the Sunbridge Capital Emerging Markets Equity Strategy. While Sunbridge launched in July 2021, Sunbridge's Chief Investment Officer, Anindya Chatterjee, has managed this strategy since its inception in December 2011. So Anindya is here with us today and will be leading this webinar. We felt this was an opportune time to discuss emerging markets, as the past 12 months have been difficult for EM investors like us, particularly those investing in China, with the MSCI China Index losing 38% in the last 12 months. But we're calling for a bottom in the Chinese equity market. Anindya and all the Sunbridge analysts have lived experience in emerging markets. Our analyst team is on the ground in China, Mumbai, and Hong Kong. So for today, Anindya will be sharing his insights with you on emerging markets, particularly China, and discussing the catalysts he sees on the horizon that we believe will turn sentiment on emerging markets equities positive. So we'll follow the presentation with a Q&A session. Feel free to enter any questions you have in the chat, which you can enter by clicking the chat icon on the top right of your screen, and we'll address them at the end of the session. Or during the Q&A period, you'll be able to raise your hand using the reaction icon also on the top right of your screen, and I'll unmute you so you can ask your questions to Anindya directly. And we'll also be recording this session, and we will send out the recording to all the participants. So before we get started, I have to give a little disclaimer, as we're going to be discussing our opinion on future outlooks as well as portfolio performance. So as all of us should know by now, past performance is not indicative of future results, and there are various risks involved in investing in emerging markets. So we ask you to please pay attention to the disclosures at the end of the presentation. So we're very happy to have you all here with us today. So without further ado, let me turn it over to our Chief Investment Officer, Anindya Chatterjee.
Thank you, Kate, for the introduction, and hello, everyone. So today, the topic of our webinar is emerging market equities. Is this the turning point? Well, as Kate mentioned, for the last 1 year, it has been treacherous. MSCI China down more than 30%. Almost 40%. And if you look at the last 10 years, emerging markets have underperformed. So if we are talking about a turnaround, it has to be something significant. So just looking back, why are we talking about this now? First, for the last several months, many allocators have come and asked me, have we reached the bottom? Well, looking back, emerging markets equities, their earnings actually lagged US equities earnings. So if you look at the EPS comparison, and we'll go there, but the underperformance has been significantly more. So emerging market equities are significantly undervalued relative to the US. Historical in comparison with the US and with its own history. For the last 4 years or so, emerging markets equities did try to turn around a few times, but it got frustrated either by local politics or policy or geopolitical events. What we see now is very significant. Firstly, China, which is 18% of the global GDP, China, which is the largest weight in the emerging markets index, is thoroughly underowned. Several large investors considered China as uninvestable and sold out of China. So firstly, you have a very large market, which is significant in contribution to global GDP and growth, very underowned. And then we see significant policy stimulus coming out of China. And that's very important, and we'll discuss in greater detail. And that's the key, the valuation and the fact that China is now turning around on the policy front and going to act on stimulus is huge for the outlook in our view. Now let's look at the underperformance. This is the chart that plots MSCI EM relative to the S&P 500 index over the last 7 years. So as you can see on the chart on top, from 2015 to 2018, the EM index, fell and then tried a turnaround by 2018, early first quarter of 2018. It was not underperforming S&P by significant margin. It was close. But between 2018 and current, it has underperformed S&P by as much as almost 50%. Now, as I mentioned, S&P had earnings growth. In the last 7 years, 2015 to 2022, S&P's earnings, the S&P 500 index earnings, more than doubled, 110%. EM lagged. It still grew 83%. Now, we all know there was tax cut, there was massive fiscal stimulus, there was Fed pouring money in the economy, all that happened in the US boosted earnings. EM was not that shabby, but EM underperformed S&P 500 by 46% since March 2018. Now, we only go by the momentum, most of us, and see, okay, EM is discarded. It's been a useless diversification, only value destroying, prospect, but things do turn around, and there are enough reasons for that. So what we want to do is quickly go through what headwinds did EM face and why would they not continue hammering EM going forward. So let's look at this period 2018 till date that EM underperformed by 46% S&P 500. What happened? We identify 4 key large headwinds that impacted EM. So first was the China trade war. In January 2018, if you remember, Donald Trump came in and waged a war against China with unprecedented tariffs. And it was not just tariff, it was kind of identifying China as a competitor and how to create a multifaceted war, I would say. So you had not just the tariff, but even SEC coming out and saying that, okay, Chinese ADRs may get delisted because we don't have audit access, and there was a huge uncertainty on the numerous Chinese ADRs that were not dually listed, and also for those that were dually listed that kept on falling in terms of equity market performance. Then you see this MSCI China, it did fall a lot with this trade war, but it started moving up as China announced a whole host of stimulus packages to shield their economy from the trade war impact. But then you had the COVID, and COVID, of course, impacts everyone, right? Developed markets, you heard in the initial days how Europe reeled under COVID, from Italy to France, across the board. And actually, EM was faring better at that point of time with their ability to do strict lockdowns, but every market suffered. And then you had the China regulatory headwinds coming in. That was, initiated with the pulling out of the largest IPO that could have been, the Ant Financials, in November, December 2000. And the regulatory headwinds continued through the period until March, when the regulators came in and said, we have done enough. And that is the first green shoot of turnaround, we would say. But however, more recently, we had the Russia and invasion of Ukraine, tremendous uncertainty for global asset markets, but for our markets, for emerging markets. Now, for EM index, as you know, nearly 75% of the EM index is Asia. Asia is key importer of crude oil and commodities. It's the manufacturing backyard of the world. So when uncertainty drove up crude oil and commodity prices, it impacted our markets more. And you can see how downward draft we had relative to S&P, which remained unscathed with further monetary stimulus. So we want to just attack each of these and see where we are going on this. So on the trade war, when the announcement happened in early 2018, the the MSCI China index fell 33% over the next 12 months. That was how severe the impact was. And China initiated some modest stimulus packages, about 3.5 trillion RMB, that helped shield some, but it did not really reverse the trend, and it ratcheted around here. Then came COVID, and as I mentioned, COVID impacts everyone, right? But the access to vaccines was not equal, and emerging markets lagged in the vaccination drive. What you see in the chart on the left hand, so for all those who have the presentation on the screen, but there would be some that are dialing in, we are referring to a presentation that we will send across to you. It would be difficult if you don't have the visual effect. What we are saying is the COVID vaccination, the penetration, the 100% of population coverage happened in developed markets 6 to 9 months before emerging markets. Emerging markets lacked that access. Not all emerging markets are same, and China lagged somewhat on the later phase. Philippines lagged a lot in the middle. So they are different, but overall they all lagged the developed markets, and that made a huge difference. And on top of that, the developed markets did massive stimulus to weather the effect of COVID. So you have Germany and UK and US all putting in 35, 40% to 25% of GDP fiscal and monetary stimulus. And the reported figures are, I would say, less than what the actual were. But if you look at China and Philippines and India or Brazil, none of them came even close to 10% that way in terms of fiscal initiatives alone. So emerging markets did not stimulate their economies to weather COVID as compared to US and the developed markets. That's another reason why the market suffered there. So we discussed, we talked about the trade war. We all know about that, how it impacted China in particular, and China is a large part of the index. Then you had COVID, where emerging markets lagged in vaccination and there was no stimulus. That caused emerging markets to lag further in the asset class comparison. And then the regulatory headwinds in China came in. That's where many people thought China is not investable anymore. You had the first big event, I would say, was in November, December, when Ant Financial was pulled out of the IPO. People were beelining for that IPO, and it was a huge event that it'll get listed in Hong Kong, raise billions of dollars. And then it was followed by a whole host of actions. Regulators, pounded on rideshare, saying that their AI is, security breach, and they went after the e-commerce companies, saying they have predatory pricing, among other things. They control the social media, the short video, gaming, you name it. So, and then they, in one stroke of the pen, essentially wrote off the online education sector. And these were large companies listed in the US market as well. So every other day, you would have some regulatory initiative from China that would be hurting their own companies. So people didn't realize, where things were going. And then in August of 2021, President Xi Jinping came out and articulated more about the Common Prosperity Drive. We have a white paper on that, and we did presentations on that. We tried to unearth what it means and what it would mean in the long term. In the near term, it really created a lot of uncertainty, as people didn't know, nobody knew what they would do to private sector in terms of policies. And this was all the policy headwind that impacted China in particular and how it fell. And you see our bottom here, March 16, 2022. That is this year, 2022 March. This is when the vice premier came out and said, okay, we had enough. We have just done too much too fast, and we would slow down. We would take a much more moderate measure against when releasing new policies, we would want stability in the market, etc. So there was a whole host of statements that he made, but people were not very convinced because he's not high up there. This may not be coming from President Xi, and it fizzled out. There was a quick rally, and then it started fizzling out for various reasons, though. It's not just that. People were not convinced whether it was the unanimous Communist Party's initiative outline, or it was just a calming of the market by the vice premier. But then you had the Russia aggression on Ukraine happening, and then commodity prices rising, and a resurgence of COVID in China. So underperformance, got accentuated by what? To see the magnitude between February 21, when we got to know about this, Ukraine invasion, it seems like years now we are living with that, but it was that recent. And between February 21 and March 15, MSCI China lost 26%. Remember, as I mentioned, China, India, all of Southeast Asia broadly are importers of crude oil, and they're dependent on that. And crude price of 130 and 150 is not good news for this zone. Now, China COVID also, there was a resurgence. So there was lockdown from Shenzhen to Shanghai and Beijing and several other smaller cities. Almost 30% of the capacity was under lockdown for much of April. Now, amid all this, the Communist Party in China came out and declared that they have a goal, GDP goal of 5.5% in 2022. That looked pretty absurd. In the second quarter of this year, Chinese economy is likely to contract. Forget about growth. You have April IIP down 2.9%. You had retail sales April down 11%. You had residential property sales down 32% YOY in April. You go anywhere, you look at announcements by Starbucks and Yum. They're down anywhere between 9-10% and 30%, 35%. So all indicators point at a contraction in the second largest economy in the world. And it also created supply chain disruptions that impacted all of us. So how on earth are they going to have 5.5% GDP growth? Obviously, they have to stimulate the economy. And, there's a significance to this. And I'll come to that on their projection and what happens. Just as you don't fight the Fed in the US, the Fed gives indications to the market that, okay, we will have a few 50 basis point rate hikes, for example. And then you don't start building your financial model based on, okay, we will have no rate hikes or 25 basis point rate hikes, right? You can take a view of whether economy will collapse or, inflation will come down sooner than what Fed says. But that Fed is giving indication to, so that the market can adapt to it. And it's not trying to misguide the market. And the same way, the Chinese regulators, when they come out and talk about a GDP growth, they do whatever to achieve that. At least that intention is never questioned. Now here, as investors, we need to look at fundamentals. And you might say that I said, it was very attractive in 2018 also. It was always like this for a while. What's going to trigger? I mean, unfortunately, we didn't have a very big trigger, and there were negative triggers, whether it was a trade war, whether it was the COVID, or whether it was the Russia aggression in Ukraine. One thing or the other, there were large global geopolitical policy, etc., headwinds that came in, that valuation went into the back burner. Nobody cares. I would rather buy crypto, or I'll buy some company 10 times earnings somewhere else, but I don't want to go into emerging markets. So EM is trading close to one standard deviation below its long-term averages. China is trading at like digit earnings multiple. Is very attractive. So what are the catalysts? So I was talking about the government's GDP forecast or their target, and what happens. We looked at the last 10 years, you can go back further. When they announce a growth, they do whatever to achieve it. And typically, they, in the past, probably under promised and overachieved. And that was the investment boom period and the debt boom period as well for China. They tried to rebalance the economy. We know all of that. They skipped their GDP target last year. That is in 2020, they skipped it. And then this year they came with 5.5%, when Bloomberg, I think, is ratcheting to 0 or 2%, and there are several economists who are anywhere between 4 and maybe 0. So it is very different from what the market perceives and what the policymakers project. We believe that they would do at least a 5 to 7% of GDP fiscal stimulus. Fiscal and monetary stimulus combined would be significant for the economy. So far, so on March 15, the vice premier came and said that on the regulatory front, they'll go slow and they'll do whatever to stabilize the markets. Then in April end, we had the Politburo quarter end meeting. Normally, they don't come out with significant policy announcements and rhetoric after that as such, but this time they did, and it surprised the market. That was the end of the April of this year, when they came out and said they will stand by whatever it takes to achieve the growth. They will do stimulus packages. They will boost consumption. They identified strategic industries that they'll push, whether it's renewable energy and automobiles and airlines and consumption. And then we saw several of the provincial governments throwing relief packages that have never been seen before. So bear in mind, we have our boots on the ground. We have our analysts in China, we have our research team in Hong Kong, and we are scanning through local provincial news. We are scanning for every iota of information that we can gather from the public sources on the local newspapers and local websites of what they're doing. And it's just quite astounding, where they are now throwing consumer vouchers to people in Shenzhen, for example. They did one project like that, where they are pushing consumption vouchers through the social media that they were bashing earlier, and the chat windows. So I'll just skip through this. Basically, what this slide shows, you can check it out later in detail. Every time the Chinese government did significant stimulus packages, Chinese market did rally. It is like every time Fed does a significant cut in interest rates, you don't want to short the market. This time it has been a prolonged decline, actually a 54% decline from this peak to this bottom in 2000, from 2020 end to 2022 March 15. And now they have come, and they were never talking about any stimulus or any growth or any consumption boost that they want to do. They were actually bashing their own companies and destroying value while they talked about common prosperity, etc. Here, now they have just started talking about the policy stimulus, and we are seeing a bottoming of the market, and that's why we are calling it a turnaround. Now, what are the catalysts? The 5.5% GDP growth forecast. The PBOC in the middle came in and issued some measures. 23 measures to ease liquidity. They cut the 5-year rate that's linked to the mortgage rate by 15 basis points, the biggest cut actually, but I think they'll do more. And PBOC is trying to push loans to provincial governments and LGFBs. People might be talking, are they going back to the 14, 15 to some extent? We could see what they did earlier in 2014, 2015 and 16, but the budget deficit target, they have not moved yet. I think that's likely to happen. And they're also pushing the capability one rung lower to the states and the provinces. Of course, there are talks of the tariff reversion as well by the Biden regime. We are not counting that in, but that's a possibility because the Biden regime in the US wants to attack inflation, right? That's our biggest risk for the current government in terms of its approval ratings. And, people are hurting here. So there's no point in putting massive tariffs on the imports anymore. So that possibly could go as well, could form a trigger. But we are focusing on what China can do. And we feel that China is likely to announce, they have already announced about 5 trillion yuan of stimulus. And that has happened almost every day since this end April Politburo meeting. There was an unconventional cabinet and the state provinces meetings just about, I think, 72 hours back. And then they announced a 33-point measure. They're putting, stimulus in the form of tax cut for automobiles and several other sectors. So far about, I was calculating, since the presentation went to compliance for approval and, sent out and all that in these 15 days or so, a lot of things have happened. So it's more close to 5 trillion, $100 trillion, 100 trillion RMB economy, roughly. I think the stimulus package would go up to from 5 trillion to probably 7 trillion, or maybe even more. And that'll be a combination of GST relaxations and income tax cuts and consumption vouchers. Now it can be funded through the SOE dividends. They have relaxed that. I think the state governments have raised about 3.65 trillion in special bonds already, and further off-balance sheet measures are very likely as well. I do want to highlight key risks. Of course, there are a lot of uncertainties still, so the market is not just skyrocketing there. There has been a turnaround, but we will never know whether in the US or in the emerging markets, whether it's a dead cat bear market rally or whether it's a turnaround. For the US, it has been a sustained rally for a long period of time. For EM, it has been a sustained long period of underperformance. And here, the second largest economy is talking about a major stimulus, which they had not done before. The risk remains whether they are going to follow up their announcements with real action. So but we are seeing indications that they're doing. So we would put a low probability that they'll not follow up all that with actions, but it remains a risk. Now, geopolitical events, we don't know when the war is going to end, whether it'll get more complicated with more nations wanting to join the NATO, and whether US intervention or rather aid to Ukraine in the form of ammunition, providing ammunitions can further escalate the situation. It's very hard to say. And whether there'll be more sanctions, whether there'll be more nations that will get sanctioned, that we have to live through. And that's, of course, a big risk factor for all asset markets globally. And then COVID surge in China. So China did not vaccinate their population with the mRNA vaccine. They, in the initial phase, did badmouth that process, we know. They pushed their own vaccines, which may not be as potent, but they need to further increase the penetration of vaccination, particularly in the older population, where it's about the double vaccination, penetration is in the 60 percentage points, in the 60s. That needs to be pushed up. And we can see one of zero COVID implementation in the form of, lockdowns in smaller cities, at least the larger ones, the, Guangdong region and Shenzhen and Shanghai and Beijing has gone through it. So the worst is over there, but the COVID fear may revisit us. These are the key risks, but remember, valuations at one standard deviation below long term, China is under-owned without any doubt. There's a large portion of investors who saw easy trade, super cycle in commodities, just dump everything and buy crude and commodities, and it's the most over-owned trade, let me tell you. So, there are people who just exited China. So it's under-owned, extremely cheap in valuations, and there's a big stimulus possibility. And it's already in action. We are seeing all of that, and we're following it day to day. I will, just quickly mention a few key holdings that we have. By the way, I'm not a stock analyst, and I'm not, recommending or a buy or a sell. These are stocks that are already published as holdings in our fund. Personally, I've met the managements of each of these companies several times. Unfortunately, I can't now travel to China and meet, and in Hong Kong, we are doing Zoom calls. Great Wall Motors, local auto company, leading auto company. It's the largest, player in the truck category. It has 10% market share in the SUVs, trading at hardly 11.7 times earnings. If you look at the chart of it, it's a sad story. How badly it has got battered. In the next 2 years, we see 30% annualized earnings growth. It has got a whole range of new products coming in. It's a leading manufacturer of new energy vehicles in China. Just to put it in context, just in the last 12 months, it sold about 140,000 electric vehicles. Of course, there are concerns about chip shortages and commodity price hikes and all of that. All the bad news is already there. So the government is pushing the local companies with stimulus. That's one thing. But we are seeing with the low base, good growth in earnings, and the valuation is very cheap. Yum China, I talked about, can you imagine they actually opened 2,500 stores through the COVID period? So they changed their business model with a hub and spoke model where they are opening very, very small outlets so that they can deliver. And their earnings are growing. There in the next 2 years, we are seeing that on a forward earnings basis, they're trading at 20-21 times. And consumer companies like these in emerging markets trade at 30-40 times earnings. This is an incredible brand. I mean, they have beaten McDonald's straight out across China because of the adaptation they have done to local cuisine. I won't go through this. It's another example. The brand Shark Ninja is actually owned by Joyoung in China, and they are 30% market share in the categories that they play in consumer durables in China. A stock that has incredible brand of global recall now and the technology access thereof. And it's growing in each of these markets in market share, is trading at less than 8 times earnings. In the next 2 years, we see 20% earnings growth in Shark Ninja. Another very bombed out stock, just about bottoming out and moving. If the consumer consumption thrust happens in the stimulus, as the government is saying, this is not buying a car, high-end car or diamonds. This is something that people need, and they buy. And this is discretion at the lowest end for the mass category. I need to talk about this because I think tremendous amount of questions have got on Sea, where we had a large position. It got completely derated as people thought its gaming business is going south. It has one game, and it got booted out of India and all of that. It is probably the cheapest e-commerce company in the planet when you look at its capabilities ranging from e-commerce to fintech. It has a solid gaming business. It generates cash from that, and it spends out of that to grow its other businesses. It has managed to be in a leader among top 2 or top 3 player in each of the markets that they have entered. They have guided that they will be profitable on e-commerce over the next 2 years, particularly Southeast Asia and Taiwan. They are spending a lot on new games. So we have to see what happens there. But it's not a company that is borrowing at a rising interest rate scenario to fund its business. It's not a cloud-based company that's trading at 10 times its revenues. The gaming company, the gaming part, we do a SOTP on that, and we are valuing its gaming at 10 times earnings, and e-commerce at 2 times sales, not 10 times sales. And there's huge upside in this. So we continue to hold this. I'll stop here. We do detailed analysis on each of these companies and can talk hours on this. This is a session where I am hoping to have a very active, interactive exchange. So let me stop here, hand it over to Kate, and let's hear what the questions are so that I can address them.
Well, it looks like everyone is being shy at the moment. Oh, here we go. We have Naj. You should be able to ask your question now, Naj.
Hey, Naj, how are you?
Hi,
Naj?
how are you? Can you hear me?
Yes.
Yep.
How are
Great.
you?
Thank you. Thank you for your comments here in India. It's very helpful. As I think about all your comments you made, for me the takeaway is that the China valuation, EM valuation is all-time low historically compared to itself and to US particularly. But internally here we always talk and discuss about quantitatively what other catalyst would be present to drive this valuation disconnect, and we always think about, is something is cheap for a reason. And one of the points you made, I guess what you're saying is that there was all this damage done, whether it's COVID, whether it's stimulus in the US that wasn't in EM, but now that tailwind of, I missed the numbers you mentioned, but $5 trillion, which should go to $7 trillion in China stimulus, that should bode as a stimulus. Is that what you're saying?
Yes, so 5 to 7% of GDP stimulus in China is very significant. That's not what people considered or factored in at all. In fact, it was like nothing more negative could have been there in the horizon, because they were bashing their own companies, they were destroying their own value. So China became uninvestable, it became under-owned, hugely under-owned, and now they're realizing that they've gone too far. They won't achieve growth. There'll be unemployment. 10 million Chinese students are going to enter the job market this year. And the companies that we are talking to, most of them are announcing layoffs. So it is a difficult environment. And President Xi is going for a re-election in October, November. There has to be stimulus. We were speculating on the stimulus, but we were not getting it from the mouths of the regulators in China. And that happened in April. It's a huge turning point in our perspective. And the quantum, as we are seeing, will be significant. So it may trigger people now coming back in China, which is very under-owned. That will be a flow inertia as well.
That's helpful. And then in terms of, I guess, the GDP prints, you said the Chinese economy was contracting. Could you just share some numbers? Obviously, I'm trying to compare this to the target of 5% that the CCP has noted. Just out of curiosity, how much, what's the spread there?
Yeah, so this quarter, I think the GDP growth in China may be zero. Okay, while people may think it should overall contract hugely, but a lot of the demand is pent up and it comes back. So when Shanghai was blocked, nothing, consumption fell a lot, and now, auto and everything is seeing a surge back in demand. So people may have got very pessimistic, but as we are ratcheting and fine tuning our numbers, I think zero growth is a possibility. So the average growth for the first half probably would be in the range of 2%. So that's why many economists are extrapolating and saying they thought, okay, 2% growth for the year. Some of the houses did 3 or 4%, hoping that in the second half there will be some acceleration. Now with the stimulus, with a 5.5% growth expectation, you can do the math, like 2% in the first half. So you have to do massive growth in the second half. Part of that is possible because of low base, but based on the scenario, I think a 5 and a 7% of GDP stimulus all bunched up in the second half is necessary, and then you might be able to have very close to may not be 5.5%. They'll announce it is 5.5%. They'll never say we didn't achieve it, but I think then a 4% plus growth is possible.
Very helpful. Thank you.
Well, I have a question for you, Anindya. So as you're thinking about investing in China, are there any particular sectors that you think should be owned or others that should be avoided?
Right. Firstly, the most battered sector in China was technology, e-commerce, and social media and gaming, all of that. Now, are they not going to do anything? Are they going to continue to do some of the stuff? There is always some risk because they do have a long-term goal of what they want to achieve. And they're not going to abandon that because of the GDP situation and the growth situation right now. But bulk of the measures that they're going to take as we envisage may not be further, detrimental to companies like, say, Tencent and Alibaba and JD.com or Meituan. So our holdings that we have in China technology, we hold on and we add to those. These are companies that are definitely going to benefit, particularly if the government just leaves them alone, which is, they don't have to do much. They just let them do their business and they'll do much better. So technology in China is one, but our main focus is consumption. And that's where the long-term tailwind lies. Now, it is frustrating for many, but the reality is that we are long-term investors and we are not going to swing around based on short-term momentum. If our long-term thesis gets challenged, that's another thing. But I see that it's aligned with what Common Prosperity Drive and what China is trying to do at this point of time in terms of throwing consumer vouchers and lowering income taxes and lowering GST. So from consumer durable mass end to lower priced automobiles to anything in Yum China, these are companies that would benefit significantly in these in the stimulus phase as well. So we would further remain constructive in China consumer space. Now, with China coming back in focus, there is likely to be some reallocation of investment weights by global investors. So some of the markets that are richly valued, whether it's or some of the markets that have rallied a lot, are likely to see some money pulled out of those and move, that money moving back to China from a flow perspective. So India is a very richly valued market, but it has rich prospects as well. So it's probably finely priced. But at the margin, there could be some selling relative performance weakness there as money flows back to China. Same could be talked about Brazil, where there's elections. There would be some uncertainty. The market is up more than 20% year to date. A lot of it is currency driven. There could be investment reallocation out of Brazil as well into China.
India, one more question, please. With respect to, so you talked about the favorable sector being China consumer space. What is it to say that the CCP may not create headwinds for that sector, in the future, just like they did for technology? Some compare contrast would be helpful for me.
Yes, so it's a very good question. So China did regulatory headwinds unprecedented, and now they're saying, okay, we have done enough. That's not enough, and market has to see for a long period of time that China acts more market friendly. and doesn't do ad hoc policies that suddenly damage the value of the companies and hurt minority shareholders. So there would be a risk premium attached to China for a long period of time. There's no doubt in that. So China trades at 8, 9 times earnings. It's not going to trade at 20 times earnings like India. I mean, India doesn't trade 20 times earnings right now, but it was. It's in a rich valuation zone. It'll take a long period of time for China to come back to a normalized EM valuation, from a EM valuation perspective. But we are looking at a turnaround because of this policy-driven initiative, and the long-term growth prospects of certain categories in China are very bright, even if there would be measured regulatory headwinds in future as well, for sure, because China has laid out what they want to do in the next 10 and 15 and 30 years. They have a 2035 target of what they want to achieve in terms of per capita income and distribution of income and all that. How many people they want in what income category, for example, in their detailed reports. So that'll have significance in taxes and some of these large tech companies and consumer companies as well. So, and we have to navigate through. It's like, look at the US market, and you would have political changes after elections that could be unexpected. That's all priced in the market, and market behaves based on that expectation. So some people ask us, why did you even stay in China when it was going to fall 54%? You have been investing in China for such a long period of time. Shouldn't you have had that wisdom to just sell everything and start buying Brazil or Petrobras and all that? First of all, yeah, we avoid oil companies, by the way, and paints and the poor ESG companies, which we don't talk about because we are not a ESG mandate, but that's how it is. But the reality is that we look at multi-year trend and whether there is prospect over longer term. We reduced our positioning. We did cut our China exposure, but we didn't get out of it because you'll never catch the bottom. And the spring back will happen so fast that you'll see that you didn't do nothing by trading out in and out. We think that the long-term normalized growth trajectory in China tech and China consumer is still very attractive, and we are incorporating this prospect of measured, regulatory interference.
Thank you.
I think there is another question.
We have a question coming in from Alex. Hi, Alex. You should be free to ask now.
Alex.
Hey there. Good afternoon. Well, good morning on my end. Can you hear me okay?
Yes, I can.
Fantastic. Probably a more difficult question to ask, but if the U.S. markets and U.S. economy does head into recession, despite the value that you have in the Chinese market, do you see that the Chinese market and investment opportunity could be uncorrelated to a decline in the S&P in our local markets here? If so, do you think that we're tied with less downside risk in the Chinese market due to the value and the discount there versus the S&P and kind of our valuations? Can you speak a little bit to what it means if the U.S. economy falls into recession while the Chinese economy is trying to stimulate and get growth going again?
Very good question. So we did a pretty detailed thought piece on this in our 2022 outlook. Look, in the last 35 years of the history of the emerging markets index, there has never been an instance where the US market was down for the year and EM was not down. Or in other words, EM was up. It never happens. So if S&P records a negative year this year, going by data, then we don't have evidence to show that EM will be up, okay? Look, in this presentation, what we are trying to establish is EM should relatively outperform. EM should narrow the gap of underperformance. The gap of the underperformance in the last 4 years had happened broadly with these 4 large headwinds. But many of those headwinds are going away. Some would stay, like the war and the COVID to some extent is staying. Trade war is already there. The duties cannot go up anymore. I think it can come down. But the stimulus is the new positive for the turnaround, and it's actually happening. We were thinking about it, but now it's being enacted. So there is a turnaround, and there could be a relative outperformance. When you are an asset allocator, you're looking at diversification. You're not going out of equity ever fully, right? It never happens. You should not be doing that. You would diversify, and that diversification logic should work here, and China is under-owned. And so all I'm saying is that I think that we have enough evidence to go out and scream saying that there is prospect of relative outperformance. Can EM have a positive year when S&P is negative? It could be because SEC and everyone tells us don't look at the past for the future, right? And theory would also say that, but we don't have the data to support that.
And I guess if I could ask a follow-up, I mean, I get the relative outperformance and perhaps the S&P and our economy pulls to a new bottom. But can I ask another one in the sense that do you see an opportunity that aggressive stimulus from China's central bank and China's government can actually help us avoid more weakness in our local economy? So if we have them providing a tremendous amount of stimulus on their end, is there any sort of help that gives us on our end with our local economy?
I don't know. So it's unlikely, I would say, because the size of the stimulus that we're talking about is still quite small, so in the global context. So unlike, say, the US and the US Fed, which has increased its balance sheet, we all know, so tremendously, China already has large amount of debt, right? So they realize that this is a significant burden and a problem. It's an aging population as well. China's race is to get at least to middle income before they grow old. You don't want China to go poor and old. And then a debt burden would be unsustainable. So I think it'll be measured. They're reluctant, they're cornered, and that's why they're doing it, is my reading, rather than they are proactively going and shooting out helicopters from their building to spread money. That's the US approach, because US is the global currency. I mean, the store of value, and that's not China's status at this point of time. So will it help at the margin market sentiment? Sure, it can. And to some extent, obviously, it will be positive. Will it be strong enough to create a floor for our US market? I don't know. I don't think so.
Great. Thank you. Appreciate the commentary.
So in India, another question came in. How do you think about the potential political shifts in the US this fall? And how will that impact emerging markets, if at all?
Yeah, so we had the Republican regime wage war against China, but the Biden regime was kind of unified with that. It's not that they were polarized on that topic as such. In fact, in some comments, Biden was even more negative on Chinese leadership and the political humanitarian aspects of China. But Biden has talked about relaxing those tariffs, and that may go into back burner if there is a change in the political composition after the midterm. because then the Republicans may want to stick to what they did. That's the tariff and the trade war they initiated. So at the margin, it could be negative, but that's already priced in that the tariffs are there. If the tariffs go away, it's a huge positive that's not even entered in the equations.
Okay, thank you.
But I have no prediction for the U.S. politics in this recent future.
Fair enough. All right. Well, I think we're just hitting an hour. Are there any last chance for questions for Anindya?
One more from Alex, if that's okay.
All right, Alex, go ahead.
Thoughts and feelings on Alibaba?
Well, very undervalued, underowned, incredible gem. Of course, the growth trajectory, what people thought 5 years back and today would be different, incorporating what the government wants to do. But can they grow more than 15% YOY their EPS? I think they very well can, and they are trading hardly at teens, in terms of they make money. So it's, a P multiple, hardly, 12, 13 times. So it's very attractive from a long-term perspective. There could be, changes in leadership. There would be, it's not a one-man company dependent, strategy. They are in so many aspects of the business that I'm very positive. On that note, yeah.
What is your current positioning within the fund for Alibaba?
I think that's a public information, Alex. So I can only talk about what is there published as the last quarter.
Sure.
That's
Sure.
okay.
I guess another question, do you see some of that delisting risk going away from Alibaba on our end with the ADR, given the recent kind of updates and rhetoric out of China?
Yeah, so at least for the companies that are dually listed, there's no major implication as such, but there are several companies that don't have dual listing, which are the key risks, and they had fallen a lot. It seems that SEC is in dialogue with the Chinese counterparts. At the same time, there are enough negative, news that we are getting in that SEC would still stay very firm. So the worst is already priced in that a delisting will happen. Now there could be company specific, relaxations. It's possible that will be partially positive, which is probably likely. But there could be a resolution of this as well, because the Chinese government did, the regulators there said, okay, there could be joint audit. Whether that is acceptable or not, whether it's an exception and not applied to other countries, and whether that will be an issue, I do not know. So it's an evolving scenario right now, and it's highly politicized. So it's very hard to say what would happen, but I think there would be incremental positive rather than the negative that's priced in. That's everything will get delisted.
Thank
Now,
you.
we are coming to the end of the hour, so I want to say, large number of people dialed in. Many of them, I'm very grateful. They've been supportive for a very long period of time. I'm available for one-on-one call. So if you want to elaborate on this, please reach out to Kate or Kurt or Mike, and we'll be very happy to do one-on-one exclusive calls with you. Thank you very much.
Yeah, and as I mentioned, we recorded this session, and I'll be distributing the recording as well as this presentation. So thank you all very much for joining. I hope you found this insightful.
Thank you. Bye now.
All right. Bye-bye.